Well, good evening, ladies and gentlemen, and welcome to part one of our continuing series of the PowerOptions suite of tools, how to use the PowerOptions suite of tools, I should say, to implement the radioactive trading techniques. I want to welcome you all to our presentation. It's great to see you all here. I apologize for the slight conflict in scheduling with the other event that's going on tonight, the State of the Union address, of course. When we planned this session, it didn't dawn on me that that was going on the same night. So I apologize for that. If you have to leave early for any reason, just remember all these webinars that were listed in the email that was sent out to you today are going to be archived and available for you to watch at your convenience later on, whenever you have the time, of course. Now, just a quick review of what was sent in that email. A brief reminder. For those of you who've joined us before for PowerOptions, using the PowerOptions tools for radioactive trading techniques, we usually spend an hour going through three principles: the how to use the search tool, using the more information buttons on the search tool to further research and analyze the position, and then how to use, of course, run your what-if reports and catastrophe reports, and then if we had time at the end, maybe 15 minutes or so, to go through the portfolio tools. What we're going to do is break that into three different presentations intermingled over the next 5 or 6 weeks with just basic Q&A sessions to help you ask any questions you might have about what was presented the week before. So today we are just going to spend a full hour on the search tool, excuse me, and try to go through as much of it as possible. And what I'm going to try to do at the same time is, of course, when we go into the search tool, I'm going to discuss most, if not all, of the criteria that are there. But I'm going to mainly highlight the criteria not only that I would use, but I feel are relatively important when you're trying to implement the radioactive trading techniques. All right, well, enough of that. Let's go ahead and get started, because we do have a lot to cover tonight, even though we are dedicating the full hour to just the search tool as well. And Daniel, thank you for the compliment. Thank you for your statement. And Norman, thank you as well. I appreciate that. And I'll try to make sure that it's worth your while. Well, first we want to discuss briefly what is radioactive trading. Most of you, of course, have the blueprint, or you're members of Fission, where you can follow Kurt's trades. But we just want to review quickly what is radioactive trading. Radioactive trading is a methodology that was developed by Kurt Frankenberg several years ago. And what happened to Kurt is what might have happened to many of you, unfortunately, as well. Kurt got into options trading by taking a weekend seminar. We paid a couple $1,000s to learn how to trade covered calls and various spread techniques. Well, in his first 2 months after taking that seminar, he had some success, but then he followed his guru's advice, did some things I would never suggest one of my customers do. He traded a couple covered calls on margin, and he ended up losing everything he had set aside for trading. But he didn't give up. He realized that his money didn't disappear. It went somewhere. So he kept studying and learning how he could protect himself. And then eventually he developed a unique form of a married put setup where he could enter into a limited risk, unlimited upside profit potential. Those of you who have been joining the webinars recently know that we're trying to take advantage of the axiom that every successful trader says: we want to keep our, cut our losers short and let our winners run. And that's what the basic setup of the RPM, what Kurt refers to the radioactive profit machine, allows us to do. Now, once that is entered, he's developed 10 different income methods that can be used to lower the initial at risk and bulletproof the positions. Now, the blueprint details the full method and the 10 different income methods that can be applied onto that original setup to potentially bulletproof the position and earn extra income. Now, what is PowerOptions? PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. Ernie Zarrenner created the site about 13 years ago to trade his own account after he retired from Hewlett-Packard. Originally, when PowerOptions was created, it really just supported covered calls, I believe long calls and long puts, and even naked puts. But just a year or so after he developed it, it had expanded based on customer feedback to support about 15 strategies. And I've had the great pleasure of working with Ernie and the PowerOptions staff for the last 8 years, and we now support over 23 different strategies. What we're focusing on tonight is just the search function. Later on, In the next couple of weeks, we're going to discuss how to use the tools to compare the risk versus reward. And of course, we're going to spend a full session on using those portfolio tools to not only paper trade, track, and manage your positions, but also evaluate various income methods, run what-if scenarios, and see which one best matches your personal risk-reward tolerance after you open the position. And as I mentioned, we've been in business really for over 13 years, and we all have many more years combined trading experience. Everyone on staff here uses PowerOptions to trade their own account, and honestly, most of the staff here implements the radioactive trading techniques, myself included. Many of you have seen some of my trades in the past archived webinars. I should introduce myself, I suppose. My name is Mike Chupka. I'm the Director of Education here at PowerOptions. As I mentioned, I've been with PowerOptions for about 8 years now. I handle a lot of the coaching sessions for those of you that are trial members or subscribers to PowerOptions. You can schedule those free coaching sessions at any time. There's no limit, and it's essentially a 40 to 50 phone conversation, one-on-one phone conversation. I'll walk you through the suite of tools, answer any questions that you have, discuss adjustments that are commonly used, but I can't give direct advice on your individual positions. I've co-authored 2 books on options investing with Ernie. I am versed in all 23 strategies we support on the site, and I've been trading radioactively for over 2 years now. I do trade other strategies in my account in addition to the radioactive trading techniques. I also apply standard collars. Occasionally I'll use a naked put transaction with the plans of getting into the stock at a lower price and then turning it into an RPM, a radioactive profit machine. Okay, now what are we going to cover tonight? Tonight we're going to focus on the search tool, how to customize the search tool in different criteria. I'm going to offer tips and some suggestions on what I look for and things that might conflict with one another when you're trying to establish your search. We're going to spend some time on how to create a search for ETFs and dividend-paying stocks, and of course also field any questions you might have about the search tool. And I'm going to pause on that and just mention that we do have a few dozen people online. We have about 70 people joining us this evening right now. Had something come through that someone lost the sound. I'm still registering the sounds coming through. If you guys can let me know if you still have sound available, if you can still hear me, I'd appreciate that. All right, so now we're getting okay. Everyone's coming through loud and clear. Okay, great, fantastic, guys. Thank you very much, ladies and gentlemen. All right. Okay, so we've got a lot of people online, and I'm very thankful you're all here. But what I wanted to mention is that I am presenting solo this evening, but I do want to encourage you to ask questions. As I'm going through the search tools, I'm going over a certain criteria. If you have questions, feel free to use that question pod and send it over to me. I'll try not to let the flow of questions interrupt the train of thought too much or go beyond what we're focusing on at that point, but I will try to answer all the questions that come through, and I'm going to try to leave 5-10 minutes at the end to field any questions as well. I'll be honest with you, I'll leave as much time as necessary to answer any questions as long as we don't go past, let's say, 11 o'clock or 10:45. All right. Okay, so we've got the introduction in place. Let's navigate over to the PowerOptions suite of tools. What we're looking at right now is the basic setup that you'll see on a PowerOptions trial account. For those of you that have a subscription, you won't see these 4 steps. These are essentially designed for trial members to get better acquainted with the tools. So step 1, the user guide. Step 2, the flash tutorials, which are available in the learning centers, the free live webinars, and of course the free individual coaching session. When we want to access the available tools for the radioactive trading technique, we're going to start by clicking on the Married Put tab. If you don't see the Married Put tab on your account when you first log in on a trial, for example, just click on the Other Strategies tab and you'll be able to customize the available strategies you have at the tab menu selection. Now, the available tools that we have for the Married Put technique, the search tool, this allows us to search across the entire universe of options to find only those positions that match our personal risk-reward tolerance. The sample searches you won't really use with this technique. Everything you need is in the search tool to start trading radioactively, but there are some themed searches in the sample searches menu that you can use as a stepping stone to create your own personal search. The search by symbol tool, if you know a symbol, you just wanted to look at available married puts or RPMs on Apple or IBM, Kraft, for example, you'd probably just link to the search by symbol tool first to compare the different risks and rewards. And then, of course, the position insurance tool, if you have a stock that's moved up in price, or you have a stock that has a different cost basis whether it's above or below, when you're evaluating a potential RPM to open on that position, you might want to use the insurance tool instead of the search tool, because the insurance tool will calculate your risk for you or your potential bulletproof status based on your cost basis, not the market price. But what we're focusing on today is how are we going to effectively use the search tool to identify RPMs. Now, what I'm not going to go through tonight is I'm not going to tell you a set of criteria that will always guarantee you a profitable trade. I don't know the market. I don't know what's going to happen next in the market, which is one of the reasons why I'm trading radioactively, of course. What I'm going to discuss tonight is the criteria that are available in the search tool, and what are some of the settings you might apply into the various criteria that I've heard other customers use successfully, whether they're trading ETFs, dividend-paying stocks, or just looking for standard new positions to open, and as well as what are some of the criteria that Kurt might adjust or that Ernie might adjust when identifying their RPMs. The great thing about the radioactive trading technique and what's in the blueprint, as many of you know, is that it's not a set list of rules where if the stock has moved up 1% on the Thursday after a Tuesday where it moved up 2% and the 5 bars of the candlestick show you a doji symbol, go ahead and buy the stock, then wait 4 hours to buy the put if and only if the put has an open interest of at least 50 contracts and a volatility or an implied volatility of between 0.35 and 0.75, assuming of course the delta is between 0.6, or I should say negative 0.6 and negative 0.8. That's not what the blueprint is. That's not what the radioactive trading technique is. The radioactive trading principles for limiting risk and taking advantage of the 3 core principles, the radioactive decay line, the at-the-money bell curve, and forcing an ideal size trade, can be applied upon any existing stock selection process you already have. And that's where the PowerOptions tool comes in, because it's flexible and you can customize it to match what you want to see. When we first open the search tool in the Married Put menu, you're going to have just the basic listing of the general criteria, or I should say the general data that you would need to just review the position. You start off with the company name. Our first result here is eBay, our stock symbol, our current price and change today, the option specifics. So we have eBay at $30.91. It was up 40 cents today, one of the stocks that was up today. And we're shown we could purchase the July 34 strike put, 2011 July 34 put with 172 days to expiration with an ask price of $435. Our open interest is 673 contracts. It's pretty solid for a far out in time option. And our total net debit, stock plus put, would be $35.26. But since we purchased the 34 put, the most we'd have at risk is $1.26 or 3.6%. And it's showing us that the option is 10% in the money. Stock's at $30.91, and that 34 put is 10% in the money. Now, the listed trades when you first open the search tool are not recommendations or suggestions. These are simply the results that match the default criteria that are listed below. Let's scroll down below the results table and we'll come back to that. Below the results table we have the parameter field, and this is where we're going to make our adjustments based on what criteria we wish to use to identify a stock that fits the radioactive trading techniques. The Married Put, the initial setup of a Married Put, is a bullish strategy. We want to look for stocks that we feel are going to be moving up in price, that we have an expectation might gain 4 or 5%, let's say, in the next 30 to 60 days. Once the stock moves up, we'll look to apply some of the various income methods, which we'll review in a later presentation this month, or next month, I should say. When you start out, if you don't already have the radioactive default criteria selected, you want to make sure that you pull that up from the drop-down menu. So in the search settings saved as field, we'll just click on the radioactive default search, and this pulls up Kurt's criteria. For the criteria that are available, there's about 25 to 30 different option criteria you can screen by, and about 30 or so 30 or so stock criteria you can filter by as well. The key is to first not be overwhelmed. We of course want to keep it simple, and there are some criteria that you will want to adjust slightly but not fully change. Let's start off on the left-hand side of the main search tool, and our column's over here. And of course, the first criteria we can use is the sort function. Right now we're sorting it by percentage maximum risk from lowest to highest. We'll change that later if we decide we wanted to sort it by the dividend yield, or if we wanted to sort it by company name, or if we wanted to do a reverse sort from the risk highest to lowest. We could change that as well. The second criteria is the first criteria that really focuses on the three core principles in the blueprints for identifying RPMs, and that is the option expiration time frame. The first of the three, one of the three core principles, I should say, is the red line, what Kurt calls the radioactive decay line, and it simply states a simple fact that most options traders, and we as options traders are aware of, when we're buying options, we want to buy further out in time. Sure, we're paying into an increased time value, but the cost per day is less. An option that is 6 months out in time won't be 6 times the cost of the same strike option that's only 1 month out in time. So when we're buying, we want to buy further out in time, and when we're selling, we want to sell near term to maximize the annualized return. In this situation, we're buying stock and we're buying a put for an insurance policy. The radioactive decay line shows us that the rapid time decay of an option really occurs in the last 60 days, really in the last 30 days. By forcing the search to go at least 150 days out in time, at least 5 months out in time, we're setting ourselves into a position where even if the stock doesn't move in that first 30 or 60 days, we won't see a rapid time decay. We'll still retain most of the value of our put option and then decide what adjustments we want to make if the stock's not going in our desired direction. Now, if I wanted to limit this specific range, if I wanted to limit my days to expiration to, let's say, be at least 150 days out, at least 5 months, but go no more than a year out in time, well, I'll just change the upper level to be less than 365 days out. I can, of course, choose specifically if I wanted to only see those positions that had leap options available. We'll click the drop-down menu from the option expiration time frame, and I can select January 2012 leaps or January 2013 leaps. Also, if you've been trading radioactively for a few months or an extended period of time, you might have a larger comfort level. What you found works best for you is trading options that are at least 7 months out in time or maybe even 8 months out in time. In that case, we'll just change the expiration to be at least 240 days out in time. What I will suggest you never do is drop that lower limit, the 150 days to expiration, the all months expiration time frame. I would never drop that below 150. Honestly, I've traded some positions that were maybe had the days to expiration were 145 days out or 140 days out. But you really want to keep that first setting at least 150 days out. This simple setting here allows us to take advantage of one of those three core principles, and that's the radioactive decay line. The next section we have is the range in or out of the money. How far in or out of the money do we want to be for our put option? The limitation we start with is keeping it less than 20%. In the blueprint, Kurt discusses how there is such a thing as taking on too little of a risk. Many of you know that if we went out right now, bought a stock at $20, and bought the deep in the money, let's say 40 strike put, well, that put is so deep in the money that the premium is going to be right near intrinsic value. It might cost us $20.10 or $20.20, for example. So if I open that position, I pay $20 for the stock, $20.20 for the put, total debit into the position of $40.20, but I have a 40 put, so I'm only risking 20 cents. Well, that's great. That's a very low risk, but now my expectation of a profit is too low. I'd really need the stock to be trading up around $38 or $39 for it to logically make sense to apply one of the income methods. So this setting here of keeping it less than 20% in the money, that's taking advantage of one of the other three core principles, and this is essentially the at-the-money bell curve. We want to move out in time. We want to move in the money so that our time value cost is less. The time value is the real risk on this RPM position. Sometimes it is okay to increase this, maybe up to 25, maybe up to 30%. I normally won't go higher than 25%. Also, I have several customers who will reduce this many of you who trade radioactively, we see results where the put might be 20% in the money and we'll have maybe a 3 or 4% at risk on our position. But when you look at the position, you say, well, I might be comfortable only going 10 or 15% in the money and having a risk of 6 or 7%. That way the stock only needs to rise a smaller percentage before you could start applying the income methods. If you were comfortable taking that higher range risk, maybe around the 6, 7, 8% at risks, but you didn't want to go that deep in the money, just restrict the range in the money, and you could put it to less than 12% or less than 15%. Another criteria, we're going to skip ahead, another criteria that will help you if that's how you wanted to adjust it, that's what you were looking for, didn't want to go that deep in the money or that far away from the stock price. We recently added, about a year ago, a filter here at the bottom of the option columns for percent to break even. Now we all know that when we're trading radioactively, the break-even price that's shown is the break-even at expiration. If I held the position all the way to expiration and made no adjustments, the net debit, my total cost into the RPM, would be equal to the break-even. This percentage break-even field allows you to limit it if you want your net debit to be less than 5% or less than 10% away from the current stock price, and you could simply restrict your percent to break-even to be less than 10 or less than 5%. Now that being said, this percent break-even and this percent range in the money may conflict with other criteria, and we'll review that in just one moment. What I wanted to discuss now is, continuing on the left-hand side, we do have columns or checkboxes, where you could select to screen only for stocks that do or do not have an earnings date between now and expiration, or do not have an ex-dividend date between now and expiration. I will personally never use these when searching for an RPM. Why? Well, again, it's conflicting with one of my other criteria. If I am looking for a dividend-paying stock and I select not to see a dividend between now and expiration, well, I'm already forcing search to find me puts for at least 150 days out in time. A stock that pays a dividend is typically going to pay it at least every quarter. So I'm going to run into a problem there. I'm not going to find any results because there aren't any put options that are at least 150 days where the stocks do not have an earnings or do not have a dividend date between now and expiration. So those fields are there, but you're not going to use them. Let's move now into the center section of our criteria. And the center section of the greater than less than columns is mostly our combined stock and option criteria and our individual option criteria. When we start off, the first three criteria are focused mainly on stock plus put combination. One of the first criteria that I always look to change when I pull up the radioactive search is the stock price, which is directly to the right of our first column here, the net debit. The net debit reflects the total cost of stock plus put. Of course, the stock price is just limitation for the underlying stock price. In Kurt's Fission account, it's based off of an account value of $100,000. I'm personally not trading that much cash or that much capital in my RPM strategies. My personal capital that I have invested in the RPMs dictates that I can really only trade stocks that are under really $40 or $45 per share, sometimes maybe as high as $50. Well, if I use that stock price limitation and I change my maximum stock price to be, my stock price range to be between $5 and let's say $50 per share, well, that's great. But the problem is that's just for the stock. If my highest maximum limit is $50 or $5,000 for 100 shares of an RPM, I can't let the net debit go higher than $50. So I'd really want to restrict the net debit rather than the stock price if that's my limitation. So here I could just put in a limitation for my net debit to be less than 50, and then I'll keep the stock price between 5 to 50 as well. Those two go hand in hand. And you can screen by a monetary maximum risk. So in that first position we saw, when we came up the eBay position, had a risk of, I believe it was $1.35, $1.36. So I could limit my monetary maximum risk to be less than $3 or less than $4, but I feel it's better to focus on the percentage maximum risk. Now to start off with, on the default screen, we're looking for a percentage max risk between 3.5 and 9%. When trading radioactively, you typically want to keep your risk less than 10%. In certain markets, if there's more volatility, if there's more action, is it okay to take a higher risk of 10, maybe 12% on your RPMs? That's not something I can answer. That's a personal decision that you'll have to answer for yourself. Yes, you can do that. I've seen Ernie enter RPMs from the starting point where he was taking a risk of maybe 11% or 12% on his RPMs. That's something you'd have to decide for yourself. But you simply want to change that criteria to match your preference. As a rule of thumb, when I'm trading protective positions, my personal preference is to have a risk between about 3 and 7%. I don't like to go higher than 7% when I'm buying an insurance policy on my positions. That's my personal preference. I honestly do not have, I could go back and do it, but I don't have any backtesting results or historical results that says I always do better when I'm risking less than 7% instead of if I got into the same stocks, what if I had taken the more at the money put or the less in the money put and taken on a risk of 8 or 9%? Would I have performed better? I can test that, but I'm not going to do that. Yes, Daniel, and that's very true. Thank you for pointing that out. I was kind of alluding to that, but you said it better. Daniel said you really have to be aware of how hard it is to make back a 10% loss. That is 100% correct, which is why the blueprint discusses keeping your risk less than 9%, and part of the reason why I like to keep my risks below 7% when I'm screening for positions. Okay? All right. The next set of criteria is our liquidity. As a general rule of thumb, the default criteria for the RPM technique starts off with an open interest of greater than 0. Liquidity, we have the option volume today, previous option volume, open interest, and our percentage option volumes. An open interest of greater than 0 is just a starting point. If you know that you typically trade maybe 500 shares in 5 put contracts when you open an RPM, I would suggest that you use an open interest that's at least double of how many shares you're planning on opening, or how many contracts you're planning on opening as well. So for the open interest, I might start off with a default range of at least 10. That's just a basic starting point. As we saw with that eBay position, when we first reviewed the results that came up, had an open interest of 637. That's a good open interest. If you had a preference to look higher, you only wanted to see put options that had an open interest of at least 100 or so forth, you just want to put in what makes you comfortable, what you would normally look for. The point of the tool, as you can tell, is to keep things simple. When you're first setting it up, it might take some time to sort of adjust the criteria and to hone it for what you're looking for. But think about it this way. If you knew when you're looking for an RPM that you would never trade a put option that had less than a 5% or less than a 5 contract open interest or an open interest of less than 20 contracts, why wouldn't you put that in to start with? Otherwise, you'll end up with results that might look good, that might match your other criteria, but as you scroll down that open interest, you say, oh, I would never trade that one. I would never trade that one because the open interest is too low. I wouldn't do that one because the open interest is too low. Why not filter that out first? Remove it first so you don't spend time going through what you wouldn't do, and the list of results that you have are really what you want to focus on before you start doing your research and analysis, looking at the stock chart and the company information. Option volume today and previous option volume is typically not something I use in the search. The reason why is because we are looking for put options that are far out in time and in the money. We have to be honest with each other. These are not the options that have a lot of activity on a regular basis. I might use a basic screen to look for an option volume today of greater than 0, just to make sure there's at least one contract or some activity today. But normally I won't necessarily use that, only because I don't want to filter out something that looks good. I'm focused more on the open interest and the total number of open contracts as opposed to the option volume today. Yes, if I'm using a shorter term strategy, the naked put I mentioned that I'll use, for example, or the standard collars, I'll look for volume today to make sure there's activity when I'm entering in the trade, because I'm only focusing on options that are 30 days out in time. But for the RPM technique, I don't really use this too much. But again, it's there for you if you wanted to use it. The percent current option volume, percent previous option volumes, I won't really use those. This is a comparison of, excuse me, this is a comparison of the option volume today compared to the total volume over the last 90 days. Some investors will use that on long stocks, long option strategies to identify trending positions or positions that are growing in activity, trying to catch the jump. That's not something I typically use in the married put search. It is something you might want to apply, of course, if that's what you're looking to do. Joseph points out, you're absolutely right, if there is no volume, the bid and ask is much greater. That can be true, but what I've found, Joseph, is that this focus on the open interest typically solves that. I have seen several positions. You've heard of some of the stocks I trade, such as Kraft, for example, Johnson & Johnson. The open interest level, I found it matches that, but it doesn't have volume, and the bid-to-ask spread is very low. Now, that being said, Joseph, if I'm looking for a wider range of stocks, which we're going to talk about in a moment, instead of looking for stocks that pay a dividend and have a lower volatility, such as Kraft and Johnson & Johnson, the bid-ask spread can be much wider. You're absolutely right. And Daniel points out again, there is a general rule of thumb where the open interest might want to be at least 10 times the number of options you need to open on your trade or your RPM. That's dead on correct, Daniel. That's what I use on my positions. So I normally have this at about 20, actually. 10 is just a good rule of thumb to start with, and I might use that as a further filter. Some of the things that I also discussed there is that have an open interest at least 10 times the number of contracts or shares you're planning on trading, and a volume today maybe of 5 times the number of contracts you're planning on trading. Okay. Oh, I'm sorry. I didn't mean to pause there. I was reading a question from John. I'm not sure. In Ernie's fish and trade, since people may be duplicating them, does the option volume open interest by blueprint users affect the trade? John, I have not seen any evidence of that happening. Like, I have to be honest with you. I've not seen any changes after Ernie opens a trade, and then when others might look at it or place the trade. I have not seen that affected. And Joseph, you're absolutely right. The difference between a bid and ask on low volume, maybe only 3 or 4 contracts as opposed to no volume. Absolutely right. All right. The next criteria there, I'm going to move along now. Thank you guys for bringing to light those issues and keeping me on pace there. I appreciate that. The next column is the option ask price. I don't use this. Normally I don't use this because it's already taken into account if I used a monetary maximum risk filter or a percentage maximum risk filter. And of course in the net debit, I'm focused more on the combination of stock plus put than the option ask price by itself. I may focus on the option time value, the time value of the option ask, but that's already reflected in the percentage maximum risk as well. Okay. The next 4 criteria I'm going to highlight will help you identify overvalued and undervalued options. These are the Black-Scholes ratio 50-day and SIV, and the IV over HV and the IV over SIV. I'm going to review these very quickly. I do not personally use these, and I'm going to explain why when I also talk about delta and implied volatility. The Black-Scholes ratio is simply the option ask price divided by its theoretical worth. The Black-Scholes ratio takes into account 5 factors, one of which is the volatility of the stock. The difference between these 2 Black-Scholes ratios is one is using the 50-day volatility to calculate the theoretical worth, and the other is using what's called the SIV, the Stock's Implied Volatility Index, which is the average implied volatility of the near-term options, the next 2 months in the money and out of the money calls and puts. Another popular choice that investors use to evaluate overvalued or undervalued options is the IV over HV, the implied volatility divided by the historical volatility, and of course the implied volatility divided by the SIV. There are 2 main reasons why I don't use these. Number 1, I wouldn't use the SIV in any case for the RPM technique because what the near-month options are doing right now is not going to be really related to the 5-month out or 6-month out put option that I'm buying. Okay, so using the SIV in this technique really isn't applicable. Now, one of the other reasons, of course, that I'm not using the standard IV over HV or the Black-Scholes ratio 50-day is because if the options were overvalued to begin with, when I'm buying, I'd be looking for undervalued options. I'd be looking for a Black-Scholes ratio of less than 1 or an IV over HV of less than 1 if I wanted to identify undervalued options. But that, again, is not my focus. I'm not focused on just the option itself. I'm focused on the percentage maximum risk of the total. Okay? And honestly, if the option was inflated, if it was greatly overvalued, let's say over 1.5, Black-Scholes ratio, of over 1.5 or over 2, it wouldn't match this risk level of between 3 to 7 or 3 to 9%. It'd have an inflated risk of maybe 9% or maybe 10% as well. Now, for that similar reason, now I don't want to dissuade you from using that if that's what you normally use to evaluate options. If you like specifically to look for undervalued options when you're buying puts, by all means, do you want to maybe use a Black-Scholes ratio 50-day of maybe less than 1.1, blank to 1.1 or blank to 1, and same with the IV over HV. I'm going to just suggest that you not use the IV over SIV because that's more a reflection of the near-term options. Delta. We're all familiar with delta. We know that if we have an in-the-money option, our delta is going to be closer to 1, or in the case of the put, it's going to be closer to -1. And if we're out of the money, the delta is going to be closer to 0, or closer to -0.1 or -0.2 for our put option. You can restrict sort of the range in the money by using the delta. If you only wanted to look for puts that had a delta of, say, between -0.55 to -0.85. Of course, you want to reverse that because it's greater than and less than. So I want to look for deltas that are less than -0.55 but greater than -0.85, for example. You just want to reverse that because it's negative values. I don't use the delta in my screens just from 2 years of using the search tool and trading radioactively because of my risk being between 3 to 7%. I know that the stocks and the put options I identify, the Mary puts I identify, just based on that maximum risk, my deltas are going to be between a range of about -0.6 to about -0.75 or -0.8. Again, I'm focused on the percentage at risk, not the specific of the option. That is a personal preference. The delta is there for you to use. Implied volatility. Since we're buying a put option, again, we're buying an option, we might want to restrict the range of implied volatility. You don't want to see options with a very high implied volatility, as that means it would be overvalued. And we could restrict that out with the Black-Scholes ratio, the IV-HV range, or restrict it using just the strict implied volatility filter for the option. But, again, I'm already doing that with the percentage at risk. If my implied volatility was too high, the married put would have a risk of higher than 8 or 9%. It'd be in that 10 to 12% range, which, as Daniel pointed out, if I suffer a 12 or 13% risk, it's going to be much harder for me to make it back. I might need a 15 or 16% gain on my next position to make that back. Little insight of something that's not in the blueprint. This is a personal preference. After a recent trade I opened, I think, in August or September, one filter I will use is the percent implied volatility range. This does not give me a measure if the option is overvalued or undervalued necessarily. This doesn't give me a measure if the stock's moving up or the stock is moving down. What this filter does is it shows me where is the option's implied volatility now compared to where it has been over the life of the option. In September, I opened, I think it was end of August, I opened a position on EPB, El Paso Pipelines, and I didn't realize it, but the option at the time had an implied volatility range, since this was open on the market, between about 0.3 to about 0.6, I think, roughly in that range. The position had the risk that I wanted, and it was a dividend-paying stock. It matched my other criteria, and I liked the stock chart. I thought it was poised to move up in price. However, the implied volatility was around 0.58 at the time. So when I opened the position, I had about a 6% risk, and I think I paid about $5.80 for the put option. Earnings came out 2 weeks later, and the stock didn't move. However, the implied volatility dropped from 0.58 back down to its average to about 0.35. And without the stock moving, my put option dropped from about $5.80 to about $4.10. Now, I still had a low-risk position. I still hadn't realized the maximum risk. But I realized the mistake in getting into positions where the implied volatility range is above 70 or higher, 70% or higher of its total range. So now, when I'm screening, I usually look for a percent implied volatility range of less than 75 or less than 80. That is a personal preference. If you want further information on that, send me an email tomorrow or later tonight, and I'll get a chance to answer you tomorrow about some of the specifics on that. And then in the next presentation, or 2 presentations from now, when we discuss researching and analyzing it, I'll go more into depth on that particular filter. But that's something I prefer to use because a volatility crush can cause your married put position not to hit the maximum risk, but all of a sudden now you realize you're behind the 8 ball a little bit because your put declined in value after you opened the position and the stock hasn't moved. If I had just waited and opened it 3 weeks later, that same strike put would have only given me a 4% risk instead of a 6% risk. Real quick, Don posted a question. He was late getting into the webinar. Well, I'm glad you joined us, Don. I'm sorry that you came in a little bit late. Will it be recorded? Yes, Don, this presentation will be recorded as well as the others we're going to do in the series later on. All right. So, going on further now, these other fields here, percent to double, and the put-call volume ratio, I don't personally use. The put-call volume ratio is typically a contrary indicator. Well, investors will use to see if the put-call ratio of, let's say, greater than 1. Some people will use that to state that the option is overbought. I'm sorry, the stock is overbought. Oversold, and they might use as an indication that it's going up when there's more puts than calls. And if you have a value of less than 0.4, most investors will take that as a bearish indicator, meaning the stock is overbought and they're expecting it to drop. I use the other filters on the right here, the stock filters we're going to get to in just a second. Don't pay attention to the put-call volume ratio. The percent to double. This is more used by long call and long put investors, speculative investors just buying calls and buying puts. It simply shows you the percent change needed in the underlying stock price in order to have your option price double. I'm not really concerned with that. I'm more concerned, again, with that range in the money, my percentage at risk, and the percentage to break even. Now, the ask time value and the ask percentage time value. When we talk about the put positions, the married put position, remember we saw earlier how we could restrict just the option ask price. But we're not really focused on just the put ask price because we know our risk, the monetary at risk, is based on the time value of the put option, and we're really focused on the percentage at risk of the entire You could filter by the time value of just the straight monetary time value of the put option. That's going to be same as the monetary maximum risk. And of course the percentage ask time value of the put option, how much of our total price is time value, percentage-wise, is going to be the same as the percentage at risk. You can use those as extra filters, but they're not really necessary when you're already using that percentage at risk field. Okay, we already, the bid-ask spread, that's our next column there in the center section. In addition to using the volume, as Joseph pointed out, to look for some volume on the position, some volume today, and a good value of open interest, so your bid-ask spread is not as wide, it's not outrageous. You know, looking at a $3 put option where the bid is $3 and the ask is $5, don't want that kind of bid-ask spread. In addition to using the volume to kind of filter that down to look for active options, you can also just use the bid-ask spread. If you only wanted to see put options that had a less than 75-cent or less than 50-cent spread, we would just plug that in there. And of course, we already discussed the percent to break even and how you could use that. Remember, one of the conflicting things I wanted to discuss, if you're creating a search, and let's say you only wanted to see positions that had a very limited risk between 3 to 4%, but at the same time had a break even, a percentage to break even of less than 5%, you're going to get no results. Why? Well, remember, if I'm looking for that lower range, that lower end of the bell curve of the risk levels, I'm going to be further in the money. The deeper in the money we go, the less percentage at risk we have. However, if I'm looking for a really low percentage risk and a really low percent to break even, it's going to be hard to identify positions because the deeper in the money we go, the lower the percentage at risk we'll have, but the higher percent to break even. Okay, so this would be a conflicting criteria. If I put in something, a break even less than 5% and restricted my percentage risk from to be only between 3 to 4%, that would be difficult. John, I typically do not use the percent to break even. I focus more on my range in the money, and sometimes I will restrict my range in the money to be less than 15%, and I use the maximum risk, but I don't use the percent to break even. I was just showing what some of my customers use. The customer who requested that we add this into the search criteria, that customer wanted to use a limit to be less than 10%. That's why I brought up that level. But I personally do not use it. I use the range in the money, which sometimes I will restrict to be less than 15% instead of the default of less than 20, but I won't use the percent to break even. Why? For me personally, the percent to break even is a reflection of where the stock would need to be, the percentage gain we'd need in the stock so it's trading right at the net debit. I'm really not focused on the net debit of the position. I'm focused on my put strike price, and after the stock moves towards my put strike price or drops or even stays stagnant, I'll look to apply the different income methods. I'm not expecting to hold the position all the way to expiration and have it above that price, so that's what we're looking for now. Okay, John, you're welcome. Dieter, you asked, why can't I enter the numbers in the same screen as you do on my other computer? It does not accept any change. I don't know if you're having some conflict with the webinar going on where your other window is not active. But what I do want to recommend is that you don't necessarily put in the criteria that I'm putting in. I am telling you what I will tend to use, what criteria I will tend to use, and what ranges I will put in, but I don't want you to trade the same way that I do. That might not match your personal risk-reward tolerance. All right, let's go back over now. We're in the center section there. We've reviewed the option criteria very quickly. If anyone has any questions just on those basic criteria, the basic discussion we reviewed there for the center section on the option criteria, go ahead and send those in. Field a minute or so of questions, and we got to move on. We're running a little bit late right now, so we're probably going to go 10 or 15 minutes over, but I do still have a lot to cover. Mary, I'm sorry, Mary, that's not really a question for this presentation. I'll send you an email tomorrow, Mary, regarding that. Mary would just wanted to know, is there a customary percent to double that is usually used on a long put or a long call? Well, the discussion is usually, Mary, the lower the better, right? If I need a lower percent change in the stock price to have my option bid price double, that would be the selection. However, again, it has the same conflict. If I'm trading long calls and I look for a percent to break even of less than, only, let's say, just less than 3%, less than 4%, that means I'm only going to be looking at out-of-the-money options where a small change is going to be needed. Shiva wants to know, are low-range stocks okay for RPM, like up to $25 stock? There are opportunities that I think are good opportunities. I don't know if you were in the beginning of the presentation, Shiva. I mentioned that my limitation for stock price is about $50. That is the most upper limit. I find on average that my personal RPM trades, the highest price stock I've bought recently was the EPB position I mentioned. It was around $33, $34 per share. And what ended up happening was that, I haven't really bought a stock above that since Fossil, which was around $38 per share when I opened that RPM. So yes, most of my stocks that I bought Kraft when it was at 26. I did an RPM on Domino's Pizza when it was at 17. You may have seen the Silver Wheaton example, and that was a purchase at $17 as well. Okay? All right. Okay, hold on. By restricting the max number of underlying in the search result, can we control and able to diversify? Well, Sergey, I would focus more on using the other limitations for the stock fundamentals and technicals as opposed to just the number of results. Again, if you know, and I'm going to talk about this in just a minute because we're going to go from scratch and create a search just on basic criteria. If you know what you're looking for, you would be able to do that. We did have an email, Sergey, I believe it was from you, requesting that feature, and I believe Ernie discussed it with the programmers. Joseph's got a more advanced comment here. And I guess you're right. He says, I'm sure that Goldman Sachs, as he used all these criteria in looking for trading opportunities. Sure, and this is one of the reasons I'm going to get to in a minute why Kurt basically uses the IBD 50 and cancel list because someone has already done the work for him. Doesn't the price of the stock and the underlying options show fair market value of the options? There are not any real ways to find bargains that others are not looking at. That's a common thought. That's probably common in practice as well. And I would have to agree with you on that, Joseph. What I think is very powerful about this search tool is that when I put in the criteria I want to see based on things that are going on in the market, on a daily basis, I'm going to find new opportunities that I might not have been able to identify on my own. I might see stocks that I've never traded before that look good or look promising. But you're right. To narrow it down and finding a fair bargain or finding that option that's just going to triple in value or quadruple in value, a lot of times we say it's already priced in. We can't control the market, which again is one of the underlying reasons why we're doing this. John asked more of a personal question. On average, how many RPM trades do you have going? I would say 5 to 6. And that, again, is based on a smaller account size, and I have other positions I trade, other protected positions. And where I'm going with that is that, I'm sorry, right now, John, I'll be honest, I only have 2 RPMs open. That's because I'm going to start opening new RPMs next week. Let's see here. Just said, it appears to me that you need a basic philosophy of trading before being able to effectively use the search tools. Otherwise, you may just well turn the account over to an option manager. I don't necessarily agree with that, Joseph. I appreciate the thought. Yeah, a basic philosophy, sure. I want some general ideas of what I would look for in a bullish stock and what kind of chart pattern I would look for a stock that's increasing. I don't want to fight the trend. Absolutely. I want to look for basic criteria. But yeah, I think that this puts me more in control of what I want to trade and what I want to do. I use this tool, but by the time I go to my broker, Joseph, I've already identified all my positions. Shiva, I'm not going to answer that question in this webinar. There are blogs that Kurt has written, other discussions and other webinars that get into that. We have to move on. I'm not ignoring your question, Shiva, but he wanted to know why not use an ITM long call. Well, instead of the Mary put, it's based on the lie of leverage. Based on the blogs, Kurt has written several things about the differences between the two. I'll maybe send you an email later, Shiva, with some of the links to those, but I'm not going to get into it right now. Let's move directly into the search criteria, and we're going to address some of Joseph's comments. There are criteria. Everything on the right-hand side is our stock criteria, fundamental and technical criteria. Yes, over time, based on other discussions I've had with other customers, what Ernie has taught me, what I've read personally, I've developed a set of criteria that I like to use to identify stocks that I feel are bullish in nature and are strong fundamentally and have strong management. It did take some time to develop that. The settings that are used here are designed to help you with that starting point as well. Now you notice just on the general default screens of the roughly 25 different stock criteria we can use, we only have a few in there. The stock price limitation, of course. There's a historical volatility limitation where we're only looking for volatility greater than 25% or 0.25 and an average stock volume. Well, that's very limited in the search criteria. Why aren't we using the other criteria? The reason why is because in the radioactive default search, Kurt prefers to use the IBD 50 and CanSlim list to narrow down his stock selections. He follows the Investor's Business daily lists, and he likes to use those. Things such as the earnings per share growth, price per earnings, broker recommendation are already factored in for the stocks to go into that list. However, if you don't follow this list, if you prefer to trade Standard & Poor's stocks, S&P stocks, if you prefer to trade maybe the 5-star groupings of S&P, we have those lists available for you to use. Also, if you wanted to just look at the Dow 30 stocks, might not have as much movement for you, but they're good solid stocks, you could select that list as well. One of the main features here for the recommended list section is that you can create your own personal list. So if I wanted, over time, if I've been trading for a couple years, I might find that there's a list of only 30 or 40 stocks that I trade on a regular basis, and I can create my own personal list and just screen against those stocks. So to do that, I'll simply click on Create/Modify Lists, and this will link me to a list where I have my created lists and my watch list from the main home menu. Now, up at the top, I can simply click the text link here to create a list, and that would prompt me to enter in a name and the symbols for my lists. Or I can even combine lists from the existing group of default lists, those company lists such as the IBD and the S&P, and my list that I created as well. So you have the flexibility there, of course, to create your own list or combine a stock list and scan just against those positions. We're going to talk about that in just a moment. If I wanted to expand my universe of optionable stocks, I would look for RPMs. The first thing I'm going to do is from the drop-down menu in recommended lists, is I'll go ahead and select no lists from the top of the menu. This opens it up to all optionable stocks, ETFs, and indexes. However, if I open it up to no lists, yes, I'm still restricting my percentage at risk, but I haven't put any other filters then to help me identify a strong stock. I still have that average stock volume in there. That's measured in thousands, so stocks that trade at least 300,000 shares per day. And, of course, Joseph, one of the simple factors that I've learned, and I'm not trying to single you out, but one of the simple factors I've learned that Kurt emphasizes and Ernie emphasizes is, hey, the trend is your friend. When I open an RPM, I'm looking for stocks that I might feel confident or I might speculate on that are going to move up 5 to 8% within the next 30 to 60 days. So I'm going to look for stocks that are currently in an uptrend, the stock price to be trading above the SMA 50. I can restrict that a little bit further. I can look for a tighter range and see only those stocks that are trading above their 20-day moving average, or I can combine moving averages. If I only wanted to identify stocks where the 50-day moving average is greater than the 100-day moving average, I could select that as well. Okay? So to start off with, though, I feel comfortable using the stock price to be greater than the SMA 50. Is this a guarantee that the stock is going to continue that trend? Absolutely not. But the trend is our friend. We don't want to fight the trend. And I want to keep that in there when I select no lists because I'm not going to look for stocks that are negative, stocks that are dropping in price or have been in a downtrend as well. Now I selected no lists. What are some of the things I might look for now if I'm identifying a strong fundamental company? Well, some of the personal criteria that I use, these are not recommendations or suggestions, this is just common approach, some of the factors I would even use if I'm trading just a naked put or standard collar, neutral to bullish stocks, some of the basics I look for. I'm just going to highlight those very quickly. The earnings per share growth, price to earnings ratio, average broker recommendation. May use beta, may not, depending on the current market conditions. The beta is a measure of how the frequency of the stock movement compared to the S&P 500. And historical volatility, I might keep that in there. The reason why we're looking for historical volatility of greater than 0.25 or 25% is on the RPM technique, you really don't want to find sort of like index stocks. IBM, for example. I was even sort of a little distraught in my last trade with Kraft because it didn't move enough for me. These types of stocks are solid stocks, but they have a volatility of maybe 0.18 or 0.15, almost the same as one of the broad-based indexes. It's kind of hard to apply the income methods on those positions with regularity, a constant regularity, if the implied volatility or the historical volatility is too low. Okay, so what would I look for from these filters? Well, the earnings per share growth, this measures the increase in earnings by percentage from last year to this year. I commonly just look for a percent earnings per share growth of at least 5%. PE ratio, a basic range is to look for a PE, price to earnings ratio of 0 to 70. Some groups, such as Investors Business Daily and other groups, will suggest maybe looking for a PE ratio of 0 to 50 or 0 to 40. That's down to personal preference. Broker recommendation, I know what a lot of you are thinking. I don't trust broker recommendations, but I do prefer to look for a broker recommendation of, let's say, less than 2.8. This is based on the Zach scale, where 1 is a strong buy, 2 is a buy, 3 is a hold, 4 is a sell, and 5 is a strong sell. So by restricting it to be less than 2.8, I'm only looking for positions that have a strong buy, or between a buy and a hold recommendation as well. I'm going to skip the dividend for now. We're going to get to that in just one moment. I don't personally use price to book or price to sales. I had a customer email in the other day, can you use the RPM techniques on small or mid-cap stocks? Of course, I've traded small cap stocks. I didn't screen for them specifically, but I ended up trading a smaller cap stock because I felt it was poised for growth and I liked the at-risk level. I think a lot of the stocks I trade, by the way, RPM techniques are in that mid-range or in the mid-cap range. And you could, of course, use the filter to restrict that based on what your preference is, but I prefer to just leave it open. One thing I commonly will do is I'll increase the average stock volume. when I have the no list, remember, selected, I'm not restricting it to any company list. I'm going to increase the average stock volume to be maybe greater than 700,000 shares per day or 750,000 shares per day to have a wider range. Some of the technicals you can use, of course, you have the RSI, the Relative Strength Index. Commonly, an RSI above 80, most investors believe that means that the stock is overbought and might fall in the near term. And an RSI below 30, many investors might take that to believe that the stock is oversold and might have a comeback later on, might be poised for growth. If I was using RSI, I'd probably be looking for a range that was maybe greater than 30. Well, I'd say maybe less than 60 or less than 50 in that range. Really, I don't focus on that too much. The percent PB and the percent BB20, that's focused on the Bollinger Bands, the Bollinger Band range, and of course the bandwidth of the Bollinger Bands. There's an article that you can access under the long call and long put menu to describe that a little bit more. And that will help you to identify the Bollinger Bands. Again, something I don't use as a starting point, might evaluate later as I get deeper into the research, and we'll discuss that in the next presentation. Mary, what is the probability above? It's not something we focus on for the married put technique. It's available because it's available in the other strategies, so we try to keep it consistent in all the search tools. This is the theoretical probability that the stock will be trading at or above the strike price of your option at expiration. The reason why we don't focus on this in the married put technique is because we're not overly concerned if the stock is trading above our put strike price at expiration. What we're more or less focused on is we want the stock to move up and get closer towards the put strike price in the next 30 to 60 days. This is more popular for standard collars, naked puts, very popular for vertical spreads, the credit spreads, debit spreads, and iron condors, not used for the married put technique. Oh, okay, sorry. I keep forgetting that when I'm reading and analyzing a question, I'm actually being silent. My apologies. I have a question come in. As far as I know, there hasn't been any discussion in the blueprint of timing your entries into an RPM trade with the overall market, which is, I guess, common sense. Does it matter the short-term timing of getting into a trade with an RPM if the longer-term trend is up? In general, I would say no, John. But I do have something, I believe, I can discuss it with Ernie. I believe he has something that he's discussed with Kurt regarding his personal timing on the trade and what he looks for. And there are some discussions, but I do focus more on the longer-term trend, John, as opposed to the shorter-term activity and the shorter-term trend. Had a question come in. What are these columns here, the Z prime score, and the Springate? These are bankruptcy indicators. The Z scores were developed by the E.I. Altman group, and the Springate was developed by an economist, I think, with the last name of Springate. These are single-digit scores where, you know, a certain range means that the firm is not likely to go bankrupt, and a range between means that it's marginal, and if it's below a certain numerical value, that means it's likely to go bankrupt. If you hover over the text link for the parameter, or you click, you should get a pop-up definition which describes that more in depth, and if you click directly on that, it will link you to the glossary page. These might be commonly, I can see how these might be useful for investors, because of course, if I'm doing a married put and protecting, I'd want to avoid positions that maybe look like they're going bankrupt or have the possibility of being bankrupt. It could be applied to the married put technique. In my 8 years of trading, I haven't seen anything with a lot of significance for Z prime, or Springate that shows me that it's very accurate. What I mean by that is I've seen companies go bankrupt that had the Z score, the Z prime score in the passing range. I've seen companies that for 5 years have been below the value for the bankruptcy but have yet to go bankrupt. It's something that is useful. It's a good economist equation, but I don't use it often. Shiva, the percent to double, we discussed that earlier in the presentation. I'm just going to say that later on in the archive, when you have the time, go back and watch the archive, and you can hear the description on the percent to double. And again, if you hover right over that, or if you click on that text link, you'll go ahead. I'm sorry, if you hover over it, you'll get the pop-up definition, and if you click on it, it'll link you directly to the glossary for the full definition there. Okay. I've reviewed some of the basics that I would use. With this search right now, let me just go ahead and submit these settings and see what we get. Let's see if we have any results. Okay. Now, the one thing I want to mention is the criteria that I implemented, just some of those basic criteria that I put in. What this typically identifies for me is what I sometimes like to refer to as the water cooler stocks. Stocks you might hear around the water cooler at work, or at a family dinner, for example, discussing with relatives about stocks. Morgan Stanley, Lowe's, Adobe, eBay, Halliburton, Morgan Stanley again, Alcoa. I'm just looking for some of the common names. And of course I do have 74 results. To me, by the way, that many results, 74 total results, is too many. I'm going to want to further tweak that criteria to restrict that a little bit more. Okay? Now, in the next 10 minutes, I know I've gone over time, but in the next 10 to 15 minutes, I'm going to go through 3 examples of creating a search from scratch. The first one is just going to be looking for RPMs on standard stocks with just some basic knowledge, as you mentioned, John. I'm sorry, not John, Joseph, my apologies. Joseph mentioned earlier about you need more than a basic understanding to identify stocks that look good. You might just want to turn it over to a fund manager, for example. Well, just with some basic principles in mind, I'm going to create a search from scratch to look for RPMs on standard stocks. And then we're going to do a quick search on how I would create a search to identify RPMs on ETFs. And then, of course, the dividend-paying stocks, some of the factors I would change to look for the dividend-paying stocks. The first step to create my own search is on the side, I will write down what I'm looking for. What I mean by that is, what am I looking to do here? I'm entering into an RPM, a married put technique, where I want to have low risk. I know I want to be at least 5 months out in time. Based on the dictates in the blueprint, I don't want to go more than 20 or 25% in the money, and I want to look for stocks that I feel are moving up in price. I'm going to put in criteria that I would use that I feel measure a strong company with good fundamentals and good technicals and are moving up in price. Essentially, we already have the search created, but let's do it from scratch. First step, I'm going to scroll down to the bottom of the parameter field, and we're going to click the Clear These Settings button. This empties out every one of the criteria in my default field. Now, 30 seconds ago, I just rattled off about 5 basic criteria that I would use, and that's where we want to start. The first thing we always want to enter, if we use Clear These Settings, or if we're changing our criteria, we need to keep the 3 basic criteria that are used to measure the 3 core principles. To apply, I should say, the 3 core principles in the blueprint, all right, for radioactive trading. The first is the days to expiration. We want to take advantage of the red line, that radioactive decay line. We want to look for positions where we're buying puts that are at least 5 months out in time. So I leave my option expiration time frame at all months, and underneath I put in my days to expiration, let's just say to be between 150 to 500 or to 600, whatever your upper range is. Again, if you wanted to restrict it to go no more than a year out in time, just 150 to 365. Okay? Our range in the money. We talked about how the range in the money helps us with that ATM bell curve. There is such a thing, of course, discussed in the blueprint as going too deep in the money, having too low of a risk. That really destroys the expectancy of profit on the position. So we might start off with a limitation of percent in the money of less than 20%. I could lower that further if that's my preference, lower it down to 15%, for example, to be less than 15%. And then third, my risk threshold. Well, I know my upper limit. We want to keep it less than 10%. As discussed in the blueprint, I can start off with an upper limit of, let's say, less than 9%. Now, my personal preference, of course, is to be less than 7%. And, of course, that restriction we talked about earlier of looking for a lower risk of maybe greater than 3%. Why am I not allowing it to go down to 2% or 1%? Because that might be too deep in the money. That is being helped by my percentage range in the money of less than 20%. But let's just put in our expectation. Let's just keep it at 2.5. Why not? We'll go 2.5 to 7%. Net debit. Let me go back to that. Okay, well, that's the first 3. You want to make sure that you have those 3 entered. Those match your 3 core principles for radioactive trading. The option expiration time frame, that's going to take care of the red line. Limiting the percent range in the money, not going more than 20%. That helps you with the ATM bell curve. and the percentage at risk, this forces us into an ideal size trade. Those are the 3 core principles of radioactive trading. Now my first preference, I know my account value. I know I'm typically not going to pay more than $50 for a stock, or that my total net debit, stock plus put, is not going to be greater than $50 per share. So I'm going to limit my net debit to be less than $50. I personally don't mind trading stocks that match my other criteria that are $8, $9, or $10 if they're available. Kurt and Ernie honestly probably won't look for stocks less than $15. Just to let you know, we all trade this differently. As I mentioned, the radioactive trading technique can be applied onto what you already use for your stock selection process. But I'll start off with a range of between 5 and 50. I can also enter that into the stock price, but remember that upper limitation. If I found a stock that was trading at $49, if the put costs $5, I'm above my total net debit cost. Spend a little time on liquidity, of course. I mentioned that a basic open interest I might use is an open interest of greater than 10, and I might look for an option volume today of at least greater than 0. Daniel pointed out that a general rule of thumb most investors use is to look for an open interest that's at least 10 times the number of shares you're planning on trading, or number of contracts. So if I was going to buy 500 shares and 5 put contracts on average, I might use an open interest of greater than 50. Okay? Personal preference again. Can you look for open interest of greater than 100 or 200? Absolutely. Put in what makes you comfortable. Now, before I go any further, I'm going to go ahead and click Submit these settings. The reason why I'm doing that is I've entered in my basics for liquidity, and I've entered in my basics for the 3 core principles. What you typically don't want to do when creating a search is put in 15 to 20 criteria at once, then suddenly hit Submit these settings. When you do that, you might get a result that says, we're sorry, there are no results that match your criteria. It's too restrictive. The problem is if I put in 20 criteria at once and then hit Submit, I don't know which one of that criteria really affected my search results, which criteria are really conflicting with each other. So now what I'm going to do is start putting in criteria, maybe one at a time based on what I'm looking for. All right. So essentially, I'm done in the center section. I might go back and use that % implied volatility range that we mentioned earlier. That's a personal criteria that I like to use. Nope, the % implied volatility range, but for now I'm not. What am I going to do? Well, want it to be the trend as our friend. I want to look for stocks that are trading in an uptrend. So I'll simply select again from the simple moving average field stock price to be greater than the SMA 50. If you like to use a bullish trend where the 50-day moving average is greater than a 100-day moving average, you could use that for your simple moving average field as well. Personal preference, again. But I suggest using a trend where you're looking for a bullish trend. Don't fight the trend. All right. We left the system at no list. When I hit clear these settings, it automatically defaulted to no list, so I'm not restricting by any company lists. Okay? Now, let's do that. Let's hit Submit these settings. I'm sorry, let's hit Submit these settings again. And remember we had about 173 results? Narrowed it down to 111. Still too many, and I haven't put in some of the criteria I would use to help me identify what I feel is a strong, stable stock. Same criteria I would use if I was doing a covered call or a naked put, bull put credit spread, or the standard collars which I trade in my personal account. We talked about those. I might look for an earnings per share growth of at least 5%. Restrict a PE ratio. I might use 0 to 70. Of course, you could restrict it further, 0 to 40, 0 to 50, based on personal preference. Might use that average broker recommendation of less than 2.8. Remember, it's based on the Zach scale. 1 is a strong buy, 2 is a buy, and 3 is a hold. The average stock volume. I'm going to look for positions again. To me, the average at least 700,000 shares per day over the last 90 days, or 750,000. Let's do 750. Okay. And again, let's talk about the historical volatility. Yes, we want to see stable and strong stocks when we're trading the RPM, but we want to see some activity. We don't want stocks that have a historical volatility that's maybe 0.15 or 0.18, 15 or 18% near to an index. So let's use that restriction of historical volatility greater than 0.25. Now, yes, I put in 5 criteria in a row without hitting Submit, and the reason why I did that is because these are all focused on things I would look for the stock itself. All right? So I'm going to go ahead and click Submit these settings. And we basically have a similar result that we saw before. Now, Morgan Stanley is at the top of the list. Now, I believe we ran that search the first time. Autodesk or Lowe's was on top. The reason why this one's at top is because, remember, I took that maximum risk and allowed it to be less than, instead of being less than 3 or greater than 3%, I apologize, I'd allowed it to go between 2.5 and 7%. Stock's at 29.34, I've got a July 35 put. That might be too restrictive for me. I might be too deep in the money. And I know that further on there's going to be other results, and this goes back to what I believe it was Sergey had mentioned. How can I restrict my results? I only want to see one Morgan Stanley trade. And instead of here, I've got this Morgan Stanley. Oh, I've got whole bunches of them. 4 Morgan Stanleys, 5 Morgan Stanleys. Well, some of them are different expiration months. This one's the 2012 Leap, and this one's the July series with the different strikes. Well, initially, because I am more familiar with it, I understand that, Sergey. I am more familiar with the technique. I would say, well, if I wanted to filter this down to lower results, what I'd probably do is have that range restricted to more of my personal preference. Again, the risk between 3.5 and 7%. And by the time I open the position, I already know if I'm planning on going to the Leap option or keeping it within that 6 to 8 month range. If you're keeping it within the 6 to 8 month range, usually you're doing this for income. You're expecting some good movement on the underlying security, and you're going to look to apply the premium generating income methods, income method number 1, number 5, or number 6. That's what you're going to be looking to do if you're using the shorter term trades, 180 days out, 200 days out, so forth. If I'm using the Leap options that are 360 days out in this case to 2012, I'm probably looking more for growth. I might not be expecting to do some of the premium income methods right away. I might be more focused on, as the stock moves up, using income method number 4 or maybe even income method number 1 combined with 4 to generate premium while canceling my risk. Okay, so that again, some of that is, I should say something, that is discussed in the blueprint, the difference between using an income approach, using it for income versus using it for growth. Okay, now what have I done with those stock criteria and what I've put in? I've narrowed this down to only 20 results. That's a good, manageable list of what I would want to screen through. And yes, I do have duplicates of different stocks, but that's going to help me. Now, I know a lot of you are saying, well, what do you do now? How are you going to further research and analyze this? I apologize. We're already 17 minutes over, and this is just focused on the search tool. Presentation 2 weeks from now is going to focus on the next step. What would I do after this? All right. I made a second promise, and that second promise was we wanted to look at how to create an RPM screen for ETFs. All right, so let's scroll down to the bottom, and we'll go ahead and hit clear these settings. One question that came in that I did want to address, Sergey just asked, do you backtest your custom screens? I personally do, yes. That's how I identified some of my criteria. I'm showing you a basic starting point of things that you might want to use, criteria you could use to identify fundamentally sound stocks, what most investors, gurus believe are fundamental criteria for fundamentally sound stocks. But when I'm looking for those lower price stocks, Sergey, I have to give in to some of these criteria. Some of those lower price stocks might not have the average stock volume specifically or have the earnings per share growth. Again, let me rephrase that. When I'm looking for these stocks here, this type of screen is looking more and focusing more on longer term growth positions, good quality positions, where I might be going a year out in time on the put option. If I'm looking for something that is more volatile, something that I might look to trade the position because I'm hoping for movements in the shorter term, I'm using a more open criteria. Yes, Dennis says the next seminar per the schedule that was emailed is 8 days from now. What that is going to be is sort of a review of what we discussed today. It's going to be an open discussion Q&A on just using the search tool. So after this webinar has been posted, the archive of this recording has been posted, and others who couldn't make it tonight had a chance to watch it. Next week we're following up where we'll review just some of this. I'll probably spend 15 to 20 minutes reviewing some of this, and then it's just going to be Q&A. You guys come with your questions, and I'll just go through the search tool based on your questions. That's next week. And then the week after that, I believe the schedule had it on the, I apologize, let me look at my schedule here, the 16th. Oh yeah, the second, I apologize. The second is the open discussion. The 8th is going to be analyzing the search tools. Okay, so 8 days from now on the 2nd is the one for the open discussion on the search tools. Tuesday, February 8th is going to be the one on analyzing the position using the menus from the More Information button. And then following that on the 16th will be the one on the portfolio, the first one on the portfolio. Okay, ETFs, very quickly. Start off in the same principles. Clear these settings, empties everything out. Three core principles. Days to expiration, 150 to, let's say, 500 days out. Taking advantage of the radioactive decay line. Take advantage of the at-the-money bell curve. We won't let it go more than 20% in the money for our put option. Percentage at risk, that's going to be your preference, but let's say 3 to 7%. You could still use the net debit, but Kurt has had success in the past trading some of the larger priced ETFs, SPY, DIA, and, well, I wouldn't say QQQ, that's in like the $30, $40, $50 range, but some of those larger ones. So let's just keep the net debit to be less than 110, just in case there's some DIA positions there. All right? Again, I will still use your volume preference. Volume today greater than 0, open interest greater than 10, or if you want to use 10 times the number of shares you're planning on trading, you can put that in as well. I'm not going to use the stock price field because I'm taking care of that with a net debit right now, and I'm actually not going to use any of the stock fundamentals. Why not? Because I'm going to restrict it. I am going to use a simple moving average. Trend is our friend. I'm going to look for those ETFs that are trading above their 50-day moving average. Okay? Basic screens, we put in our three core principles, our liquidity measure, our trend, want to see stocks trading in an uptrend, and now from the drop-down menu, I'll simply select indexes, ETFs, and holders. And then we'll go ahead and click Submit these settings. All right, a lot of copies on the queues, different months and different strike prices, but there's only 27 results. That's pretty interesting. And that could be with the fluctuations in the market. There aren't a lot of ETFs right now that might be trading above their 50-day moving average. For this also, I was hoping to see some of the leveraged ETFs or some of the bull and bear 3 times or ultra ETFs in this list, and they didn't appear, and I'm pretty sure the reason why is because of our limitation of maximum risk. Things like FAS or FAZ have a higher implied volatility. They are inflated because the stocks fluctuate, those securities fluctuate, I should say, so much in price that the risk is probably closer to 10, 15, or 20% when you're restricting it to be less than 20% on the money. So again, without even using any restrictions for implied volatility or overvalued or undervalued options, I've filtered out those leveraged and inverse ETFs because of my percentage at risk. However, in addition to selecting a stock list you wish to screen against, you can also remove various stock lists. And one of the things that you might wish to remove if you're screening for ETFs is you can select to just remove the inverse or the counter market ETFs unless you think that we're in a bearish sentiment. That's a perfect play. If you think we're in a bearish market, you might want to screen specifically against the inverse and counter market ETFs because as the market falls, those inverse ETFs are going to move up, so you can still be in a married put and have a bullish position trading an inverse ETF in a bearish market. And of course, I'm sorry, let me go back. I could also remove the leveraged ETFs if I didn't want to see the 2 times, 3 times, and so forth. I could remove those as well. Great list, 27, manageable list. Just those ETFs that have the risk, the liquidity, the range out in time I'm looking for to take advantage of the red line, range in the money, less than 20%, to take advantage of the ATM bell curve and that risk of 3 to 7%, or 3 to 9%, whatever your preference is, to force an ideal size trade. Yeah, Daniel, I know. I was going to review that right towards the end, which we're just about now. Daniel pointed out that, hey, if you have multiple stocks, you have multiple listings on the same stock, for example, different strikes in different months, you can arrange those just by sorting by the stock symbol. You can, any of the columns that we can filter by, we could select to sort the results by in that drop-down menu. And we're going to show that in just a second. We're going to do one more quick example, and I really apologize. I wanted to keep this to an hour and 15 minutes at most. It looks like we're going to go to an hour and 30. So ladies and gentlemen, I apologize for not respecting your time. But the information is a lot to go through, and I think it's very useful and very important. Okay. Instead of going through the last 3 steps, sorry, the same steps we just went through, let's say I wanted to look for dividend-paying stocks. But instead of clearing the settings, let's just take the default radioactive screen that we started with before. Okay, and I want to discuss a few things. You start with the radioactive default search as a stepping stone. You adjust your percentage at risk criteria based on your personal preference, your stock price range, of course, based on what you feel comfortable trading, what you can afford in your personal account per share. And then we say, okay, well, I want to trade dividend-paying stocks. And I'm going to keep the other criteria in place, and I'm going to keep the IBD 50 and CAN Slim list in place, and the trend is my friend. I'm going to keep the simple moving average. So to screen for a dividend-paying stocks now, all I have to do is put in my range, the percent dividend yield, center section of our right-hand columns. All right? And let's just say a basic screen. I mean, we want to see stocks that pay at least a 2% annualized dividend. I know that's relatively low, but let's just say, for example, we want to do that. Okay, so I have here 42 total results that match the radioactive screen. I did restrict my stock price, and I only want to see the stocks that pay a dividend. Let's go ahead and hit submit these settings. Wow, what happened? No stock option combinations match my search criteria. Why? Okay, I wanted to address it in this way because this is a common email I receive and a common phone call I get during, or question I get during the coaching session as to why can't I find any radioactive RPMs that pay a decent dividend. It's not that there aren't possibilities out there, it's that there's two conflicting screens that are already in the radioactive default search that sort of hinder the dividend paying stocks. The first one is the historical volatility. Remember, I did discuss that when you're trading in RPM, you want to see some movement. We like to see movement, even if it's down movement a little bit. We like to see that because that'll help us enter in the income methods faster. Raphael, I'll get to that question in a moment. Okay, so hold on one second. I got another question there from Raphael. I'll get to that in just one moment. All right. So here's the problem with the historical volatility. Stocks that pay a dividend are typically more stable stocks. They will have, most of them have a volatility, historical volatility of around 18%, 19%, 20%, and so forth. Even Kraft, Johnson & Johnson, the positions I trade. That can be a hindrance to applying income methods on a consistent basis, but that's softened by the dividend. All right, so let's take out the historical volatility field. We're just going to leave it blank. We're not going to restrict the historical volatility at all. Let's go ahead and submit the settings and see what we get now. Okay, I only have two results. This is the same thing that came up last week when we did a dry run of this presentation. I've got two positions on DuPont. Wow, so there's only one stock DuPont, and there are only two different strike prices that I could potentially trade an RPM on if I'm looking at dividend-paying stocks. No. The second reason why this is also limited, in addition to that historical volatility filter, is the IBD 50 and CanSlim list. There aren't a lot of dividend-paying stocks in the IBD 50 and CanSlim list. When I'm personally looking for a dividend-paying stock, I'll have to select no lists to open up the universe. You could even use the S&P 500 ones. That'll give you some good results for dividend-paying stocks for the RPM techniques. But I'm going to start off with no lists, and I'm going to put in those criteria I mentioned before. My earnings per share growth of greater than 5. Price to earnings between 0 to 70. My apologies. Broker recommendation. You don't have to use this. I'm just putting it in. Okay. I'm not going to restrict historical volatility or beta. I am going to increase my average stock volume. Let's just put it up to 500,000 shares this time. Not that there's any difference, but it'll just open up the universe more. Okay? So that's the problem, is that when you're looking for a dividend-paying stock based on the default criteria of the radioactive screen, that historical volatility and the IBD 50 and CanSlim list is restricting it. All right, so I opened it up to no lists, put in my criteria, let's submit. It's probably about 40 results. 122. Okay. Oh, I'm sorry. If I'd put in 750,000, we'd be lower than 122. Okay, so now I might want to do further restrictions on this. What are some of the restrictions I might do? Well, I'm looking for a dividend-paying stock, maybe a stock that paid at least a 2% dividend. Well, I have 122 results. Let me filter this down to take the better advantage. Let's increase that. What about the stocks that pay a 3% dividend yield? How will that narrow down my results? 58. Basically cut it in half. Okay, so now I could consider adjusting some of those other criteria we talked about before. Maybe using that percent implied volatility range. Maybe restricting the risk a little bit more. Maybe restricting the stock price. Okay, further narrow that down one by one. Now, as Daniel pointed out to me, once you've created your search, we of course want to save it. Simply click the Save button. We can enter our search name. And I'm just going to call this dividend stocks from, my apologies. What is today's date, ladies and gentlemen? It's the 25th, January 25th, Series 1, from Part 1 of PO Series. Okay? That's just my description. I'll just click Save this search. Now it's going to rerun the search for me. And as I scroll down below, I see that I have my list selected with the other defaults. I can scroll through other other saved searches I had during different webinars, or always go back to the default screens, the default searches there as a starting point. If I wanted to change how my results were sorted, over here on the left-hand side, we simply click that drop-down menu. I could organize it by stock price, and I'll essentially organize it by company name, from highest to lowest. If you wanted to filter it by the net debit, from lowest to highest or highest to lowest, or just by the option volume or open interest. You can, any of the filters that you can screen by, you can select to sort by as well. Now, in addition to that, what's also important, which I will save for the last as we wrap up, is in addition to customizing all the search criteria and what we talked about and what you may want to use or may not want to use based on personal preference, you can also customize the results table. In addition to being able to sort the results by any of the filters you can screen by, you can also select to view any of those filters right in your results field. To do that, simply click the See More or Less Columns button in the upper right-hand corner. Up here, let me just highlight that. There we go. And this will take you to a configuration page where you can pick and choose which columns you'd want to see. If I use the % earnings per share growth, the % dividend yield, or the price to earnings ratio in my search, I might want to use that in my results. The average stock volume, for example, or broker recommendation. If you wanted to view that % implied volatility range or the actual delta or the implied volatility of the option, just check the boxes next to the fields that you wish to use on your results field, and then simply click Save and Return. Be prompted to close the window, and then it'll just reload it. Okay, and then now I have my earnings per share growth, PE, % dividends, and my implied volatility range on my positions. Okay, so those questions. You can change and customize the filters. You can reorder these as well. One of the choices there before I saved it, I could reorder the columns based on what I wish to use for my analysis. All right, real quick, I'm going to answer some questions, then I'm going to wrap up going back to the slide presentation. Oh, I'm sorry. Raphael wanted to know, is there a way to pull up stocks with weekly options only? Yeah. How do I want to do that? Actually, no. I apologize. Right now there is not. There is going to be one that's available, but right now I can't. The reason why is because in other screens, if I'm using vertical spreads or debit spreads, I'll simply, if I'm looking for weekly options, I'll just simply limit my days to expiration. But you're not going to be able to do that on the married put screen because it's focusing on the put, not if there are other options available in addition to the put that might have different screens. So sorry, Raphael, right now on the married put screen for RPMs, you can't narrow that down. In other strategies you can just by using the days to expiration field, but there will be a choice later to do that. All right. All right, Joseph makes a good comment that I want to address. All of Joseph's comments have been great. Don't get me wrong. All the comments that have come in today have been great. But he brings up a very valid point that is a concern of mine, which is why I like doing these webinars. And I'm not giving direct advice, and I know you all know that. But what Joseph pointed out is it seemed like that most of your listeners, including me, are not, occasionally, are not sure what exactly my personal preferences are. So it's difficult to use the tools correctly. May at some time in the future do something on how to determine personal preferences, risk tolerance, etc. Just a suggestion, but I did want to address this, Joseph, because I wanted to point out that I completely agree with you. I have to walk a fine line, and you guys know this. Those of you that are familiar with PowerOptions and radioactive trading, but more specifically, those of you that are familiar with Ernie and myself and PowerOptions, you know we walk a fine line. If we had the answer, if we had the key, the one criteria that would lead you to 100% successful trades, where you're not risking more than anything else, we would gladly give it to you. I'm honest with you. I wouldn't hoard it myself. I would be happy to share that with you. But we have to walk a fine line. I can't tell you what you should enter or should not enter. I, of course, can't tell you what your risk tolerance is. That's something that you want to identify. We try to help you with identifying your risk tolerance by pointing investors and those of you who attend the free webinars towards that trade simulator tool. Work out the numbers about if I risked 8%, but I was looking to make 5%, how would that work out over 100 trades? And if I was expecting to make 6%, but I was going to limit my risk down to 4%, how would that work out for me? That's what we're trying to do with that trade simulator tool. That being said, what I'm discussing here in these webinars that go, I know we go a little bit over each time, and it's not because I like to hear the sound of my own voice. It's because I do get carried away from time to time. But what I am telling you here is not a recommendation or suggestion because I can't give you direct advice. I'm trying to show you what has worked for me with the RPM techniques over the past 2 years and what I have discussed with other clients who have been trading radioactively for at least 4 or 5 months. When they say, oh, I found that using this risk is better, or I found that, yeah, some of the criteria I'd use for a stock are earnings per share growth, price per earnings. Those help me identify good fundamental stocks. They might not be rocket ships, you know, and I'll one for admit, not every RPM I open is going to be as lucky or as fortunate for me as that silver Wheaton position was. But these are essentially the settings that I'm going to use in my personal searches there. I appreciate the comment, Joseph, and I agree with you, and that's what I'm trying to do. Don't know how to answer this question. Marilyn, does the dividend result list display the actual dividend? This is the percentage dividend per yield. We don't show the dividend per quarter or the total monetary dividend on this page. There is a field here where you can go to the, if you go to the big charts, for example, you can see that, what was the quarterly dividend payment. You can select to view that on the chart, and you can see all of the stock information we have available if you go to the research tool in the stock research. We'll be focusing on that during that research column. John, no, there is, I believe it's John that asked this question. Is there a column for days to expiration? No, there's not an individual column. It's shown in parentheses. This is the days remaining to expiration for the put option. It's shown in the column there with the put option specifics, the year, the month, the strike, and then the days to expiration. And of course, use the days to expiration to filter down your limitation of how many days are closer to it. Now, in the search tool, that's where that's shown, the days till expiration. In the portfolio tool, I just had the programmer the other day add something based on customer feedback during a coaching session. There's now an alert that you can set if you're within a certain remaining days to expiration, if you're within 20 days, 50 days, or 30 days to expiration. Daniel, can you export your search results into an Excel spreadsheet? No. I apologize for that. I know it's inconvenient in some cases for what you're looking to do. Here's why we don't do that. Number one, when PowerOptions was first created, in the first year or so when Ernie was started the company, actually he didn't start it as a company. He started it to trade his own account. In that first month or so when he created PowerOptions and put it up on the internet for some of his friends at Hewlett-Packard to use, he received several emails of investors asking him how they could subscribe to the service. So that's how it started, and that's how it began. I'm sorry. Oh, what happened was shortly after that, there were several people who started to create their own searches, just as we walked through, save their searches, downloaded them to Excel, and then resold them as their own proprietary search and proprietary criteria. So because of that, the download to Excel function from the search tool was removed. Also, we tell all of our customers, and as we've told you before, is that a lot of the changes, a lot of the criteria that we have in there, we discussed the percent implied volatility range and the percent to break even, we added based on customer feedback. Your idea for using it for Excel may be to, make it easier to copy and paste the stock symbols and import them into your broker's list, or if you have another tool that you use to evaluate stocks, or you want to use your own addition in Excel to combine or multiply or divide some different columns. If there's a criteria that you're using that you're identifying in Excel by combining two columns, for example, two pieces of data, 3 pieces of data, we have PowerOptions, give us an email or send us an email or give us a call, and we'll try to implement that if we have it. But I apologize again, we do not have a direct Excel. All right, Joseph, if you had the keys to the kingdom, you would all be millionaires. That's what makes it so much fun to know there is risk. That's right. And, of course, let's be honest. If I had the key to 100% successful trades and to make me a billionaire and I gave it all to you, well, it would no longer be the key anymore, wouldn't? The market would correct for that. All right. Okay. All right. Oh, yeah, Marilyn, the percentage, right. You can select to view that in the columns, and you can select to screen by. I'm sorry. Okay. All right. Well, I'm going to wrap up here. I'm going to have just a few review slides, and I know I went way over. I'm going to have a few review slides. If you have other questions, send them in, and I'll try to wrap that. I'll try to answer those questions as well. Probably beat this to death, but let's talk about the basic tips on the search tool. When creating a search, leave the settings for the 3 core principles. You can start by hitting clear these settings. and then put in the criteria for the 3 core principles. The expiration time frame, at least 150 days. Take advantage of the red line, the radioactive decay line. Keep that percentage range in the money to less than 20 or 25%. Helps us focus on the ATM bell curve without taking too little risk. Number 3 for the core principles, keep the maximum risk within reason. Always less than 9%. Single digit at risk, maybe greater than 2.5%, maybe greater than 3%. Again, based on the word I don't always like to use, Joseph pointed out I shouldn't always use that, but based on your personal preference, put that into play. Okay? So basic tips, whenever you start a search, if you clear the settings, or if you're just adjusting the default radioactives, keep the 3 core principles, expiration time frame, range in the money, and maximum risk, to the levels that are listed as the default. You can adjust them slightly, but don't go beyond those ranges. Okay? When creating your own search, we just talked about it, click clear these settings, input the settings for those 3 core principles, always keep them there, and the KISS rule, keep it simple, simple. To start, only input criteria that you would use to identify a bullish stock. I showed you some that I would use. You might like to use the RSI. You might prefer to use market cap instead of average stock volume, or percentage stock volume as opposed to the average stock volume. Don't feel pressured to use criteria you do not know. Okay? Yes, there's a variety of criteria there. Don't let it overwhelm you. Put in what you would normally look for. Ask yourself the question when creating a search. What would I look for? What criteria might I use if I wanted to look for stocks that I felt were going to move up 5 to 8% in the next 30 to 60 days? Plug those in to start with. Run your search. See how many results you have. And if you need to filter it down further, increase that. Make some changes to it. Further restrict them. And again, try, when you're creating your search, only enter 1 or 2 criteria at a time, then click Submit these settings. Might seem a little redundant at first, but it will help you from putting in 10 criteria, hitting Submit, and then having no results. All right? So just put in a few criteria, hit Submit, see how it affects your number of results, see how it affects your total results, and then keep scrolling that way. Okay? As we showed, when screening for ETFs, remember you can remove the inverse or leveraged ETFs. Those aren't ones you would normally trade. Simply remove them from that drop-down field. And when screening for dividends-paying stocks, start with no lists. There are not a lot of dividend-paying stocks in that IBD 50 and CanSlim list, which are in the default radioactive screen. Use fundamental criteria that apply to you, and you may want to remove or lower that historical volatility restriction. Okay. Basic subscription services. The 20-minute delayed service gives you access to all the tools. We just discussed the search tool. Again, I should say, later on this month we're going to do presentations on the research and analysis of the RPM, the steps I go through, okay, to research and analyze an RPM once I pulled up the search, and then the portfolio tools later, and then the Q&A sessions. Well, 20-minute delayed service is only $59.95 per month, a discounted rate, annual rate of $600 for the year. And then the real-time service is $79.90 per month, or $800 for the year. The historical data is not included in that. You can subscribe to a 3-month subscription to the historical data, or of course the professional level of service includes everything in the real-time data plus unlimited access to the historical suite of tools. All right, I'm not going to discuss the educational products too much. If you go to radioactivetrading.com, the blueprint, of course, is the full guidebook for the radioactive trading technique. And then, of course, Kurt also has archive CDs that focus on some of the specific income methods. If you just go to radioactivetrading.com and click on the Products tab, you'll be able to view that. Now, remember, the blueprint is the only place where the full methodology and all 10 income methods are discussed in detail. I'm just showing you the tools on how to implement the radioactive trading techniques. And, of course, I realize that most of you in attendance tonight already own the blueprint because that's who we focus this presentation for. Questions at any time for Power Options, send me an email to support@powerop.com. If you have questions about the radioactive trading technique, send an email to support@radioactivetrading.com, or you can send it directly to Kurt at radioactivetrading.com if you just wanted to talk to Kurt. Of course, you can always call us during market hours. Toll-free inside the U.S. is 877-992-7971. If you live outside the continental U.S., it's 302-992-7971. All right. Is this Marilyn? The name is cutting off. I apologize. Let me scroll up here. I apologize for that. 1 second. Okay, it looks like this is Mary. Is there a tutorial on backtesting? Yes, let me navigate back to the Power Options suite of tools. All of the archived webinars on Power Options, if you go to the main home menu, or the main home tab, and click on Learning Center, You'll then be able to navigate to the webinars from the Learning Center menu. All right. Now, you can also just access, look at the top here, if you see the URL. The webinar page is, let me just do that real quick. Hold on, ladies and gentlemen. The main link for the webinar archive, the public page is powerop.com/webinars.asp. And I'm just going to send a quick link to everyone there. There we go. Okay. All right. So on this page shows me the upcoming webinars, and over on the right I have the archived webinars. In the Power Options Tools Archive, the header, and there's a full hour presentation on the Power Options historical suite of tools. This is not necessarily, it's not directly geared towards the radioactive trading techniques, but it does go through some different principles of using the historical suite of tools, and you can access it right there. Marilyn, you're welcome. Thanks for joining me. Ladies and gentlemen, it's 10:45, and what did I say? Roughly at about 9:05, I will stay on to answer the questions as long as they're coming in, but we don't want to go to 10:45. Well, I blew through that, didn't I? I apologize for that. I thank you all for staying with me as long as you did. I hope you got a lot of useful information on this. It's not available yet in the upcoming live webinars. I'll probably post it tomorrow. Next week, Wednesday evening, February 2nd, 9 p.m. is going to be the next part of the series where it's just going to be an open discussion Q&A. I'll review some of the principles we discussed today on the search tool, but it's going to just be an open form Q&A, mainly on the search tools, but you can bring other questions that you have, of course, for the radioactive trading techniques of the Power Options tools. And then the following week on the 8th, Tuesday, February 8th at 9 p.m., that's where we'll go through the next step, and we'll spend an hour plus, maybe an hour, 15 hour, 20 minutes discussing using those more information buttons on the search results to further research and analyze the RPMs, compare and run the what-if reports and catastrophe reports. Ladies and gentlemen, have a fantastic evening. Any further questions, give me a call tomorrow during market hours. Send me an email to support@powerup.com. If you have questions for Kurt, you can just send it to support@radioactivetrading.com or just Kurt@radioactivetrading.com. Take care, everyone. Have a good night. Happy trading. We hope to see you real soon. Good night.